buy stocks, and by all means, just go ahead and buy stocks. The old advice, the traditional advice, used to advise old people always to get out of the stock market as early as possible. But that advice seems to be obsolete because individuals nowadays are living up to 80 years old, others are living up to 100 good years. So the old advice that it's only young people who are supposed to have their portfolio actually in large quantities in stocks, it is outdated advice. Most people need to be in the stock market. Anyway, if you are interested in this kind of videos, remember to subscribe, like, and also don't forget to share. So in today's video, I am going to immerse myself on how I do my own research. And one of the things which you need to realize is that I have not mastered all the things which I'm going to discuss. And as time goes by, I try to improve each and in every field which I am going to discuss. So if you are interested to understand how I go about doing my own research when it comes to investing in the stock market, then you are probably in the right place. But if you are not interested in the stock market or the bond market, then you are probably in the wrong direction, wrong avenue. Now, as I've already said, every person, every individual need to have his or her own resources in the stock market. And one of the reasons why you need to have a large chunk of your resources in the stock market is because it's only the stock market which is in a good position to beat inflation. Yeah, sometimes bonds can beat inflation, but at the end of the day, if you are going to ensure that you beat inflation by a larger margin, then you must ensure that your portfolio has large quantities of stocks. So the old advice that it's only old people who are supposed to invest in bonds and only young people who are supposed to invest in stocks, that's outdated advice and should be left aside. Now, that's the first thing which I've discussed. Now, you as an individual who's interested to invest in the stock market, why should you even go ahead and do your own research while we have fund managers, mutual fund managers who you can go ahead and invest with? From what I read and from what I believe is true, Peter Lynch, in his book Beating the Street, he said that if you dedicate a decent amount of your time, small amount of your time to researching those stocks you are aware of, those companies you are aware of, you are in a good position to beat 75% of experts who are paid in Wall Street. This can also be true in Nairobi Stock Exchange because majorly I'm going to discuss on how we can improve in our investment strategy when it comes to Nairobi Stock Exchange market. So if you realize that you have good chances of you succeeding in investing as an individual in Nairobi Stock Exchange or in any given area of your interest when it comes to the investment market, then you have good chances by dedicating a small amount of time to do your own research and understanding what these companies do. So that's why it's so essential probably to go ahead and watch this video because I am going to outline some of the things you should focus on when doing your own research in the stock market. So you have a good chance of beating individuals who are paid to do their own research. And one of the things which you need to realize, there is this investment avenue known as index funds. That's one of the best avenues which most individuals can use in order to create their own source of wealth when it comes to investing in the stock market. And most individuals who are mutual fund managers have never beat index funds consistently over a long period of time, which should be a nice gesture to you as an individual that you have a decent opportunity, a nice opportunity to succeed in picking individual stocks in the stock market. So that's exactly why you need to go ahead and take much of your time in listening to this episode. So what are some of the things which you need to understand in order for you to succeed in the stock market? Here is something which I want to assist you to come at ease, to be in good mood. that you have a nice opportunity to succeed in the stock market. To succeed in the stock market, it's not more about how intelligent you are as a person. More of you succeeding in the stock market will be how much strong your stomach is. And by that I mean, can you sustain the ups and downs which are represented by the stock market? It's not the intelligent people who become successful when investing in the stock market, but those individuals who are able to storm the market, who are able to stomach the ups and downs which happen in the stock market, and they do happen on a regular basis. Those are the individuals who can succeed and beat most of the fund managers who are investing in the stock market. So one of the things which you need to realize to succeed in the stock market, it's not how intelligent you are as an individual, but how calm are you, more especially when it comes to the ups and downs which are observed in the stock market. So to succeed in the stock market, it's not all about intelligence, but how strong are you? Can you be able to weather down the storms which do happen in the stock market? Can you observe your portfolio reducing by 50%, 90%, 60%, and be stable and not go mentally insane by what you are seeing in the stock market? If you are in that position, then you should go ahead and invest in the stock market. But if you can't stomach the fluctuations which are observed in the stock market, then you would be in a nice position either to invest in the bond market or in certificates of deposit or other avenues which don't have the experience which is being presented by the stock market. So it's essential for you to understand how you can react to different scenarios which can happen in the stock market. So one of the things which you need also to understand to be successful in the stock market, you have a good chance of you making a decent amount of resources or a decent amount of wealth if you invest in small companies. And by I saying you invest in small companies, I don't mean poor quality companies. Let's say you have a company which is a decent company selling at 10 shillings per share, and there's another also decent company which is selling at 100 shillings per share. It is much easier for a share which is selling at 10 shillings per share to move from 10 to 50 shillings per share or 100 shillings per share, compared to a company which is selling at 100 shillings per share to move from 100 shillings per share to 150 shillings per share. So you have a huge advantage if you are one of those individuals who can go ahead and find decent companies which are selling at low or cheaper prices. Not poor quality companies, but decent companies which are selling at a cheaper price, let's say 10 shillings, 5 shillings, 15 shillings. They have a higher chances of moving from 15 to 45 compared to a company which is selling at 80 shillings per share, moving from 80 to 100. It's somehow difficult. And that's why if you want good chances of creating a fortune in the stock market, you should always go for those companies which are selling at low prices. So that's another thing which you need to take into serious consideration if you are going to invest in the stock market. So we want to also develop the mindset which is going to assist us to succeed in the stock market. And one of the things which you need in order to succeed in the stock market, you should always eliminate the chances of you trying to time the market. Why is it so dangerous to time the market? There are no known individuals who have tried over a long period of time to time the market and emerged out successful. So you are not going to be the first. Probably you are not going to succeed in trying to time the market. So how can you succeed in the stock market by just not timing the market? You should develop a schedule. You should develop a timetable on how you are going to invest in the stock market on a regular basis. Either you can choose on a given date every month you should be investing, or every 2 months on a regular date you should buy stocks on a regular basis. The amount should always be the constant amount, or maybe you may decide to add some amount by you progressing. Maybe you are earning some extra income, but you should not be scared, not buying stocks maybe if they decide to fluctuate. Why is it so essential to always be sticking to your timetable? When stocks are selling at higher prices, you are going to buy a few stocks. But if those same stocks fluctuate, you are also going to buy a lot bigger number of shares because their prices are fluctuating. So it's essential to always stick to your plan when trying to buy those stocks in the stock market. Don't be scared when the stocks are selling at higher prices, and when they are selling at a low price, and when they are selling at higher prices, you get excited and go ahead and buy. So you are going to get a lot of benefits if you stick to your own plan. Another thing which we should always consider, there's this whole issue of diversification. Most individuals tend to overrate the importance of you trying to diversify. And the recommendation is you should at least have not less than 5 companies in your stock portfolio. And why is it so essential? For example, let I use a company like Safaricom. Safaricom, as you understand it, is involved in different businesses. They have the communication where individuals to do communicate through the airtime, and they also have M-Pesa. They also have other services. The company itself has already diversified. So you as an individual going ahead and buying 61 companies which are listed in Nairobi Stock Exchange, that's not diversifying. You are doing too much diversification, which is not even worth it. Maybe you want to develop an index fund, but that is not the main goal of this video. You want to ensure that you understand those companies which you are invested with. At the same time, you want to ensure you monitor their progress. By you buying a lot of stocks, there is no way which you are going to maintain and realize their progress. So you will not be up to date on what is happening to various companies which you are invested in. So most individuals tend to overestimate the importance of diversification, and they end up putting too much resources in unworthy companies while they put a few resources in good quality companies which may have at least projected them to massive wealth creation. So when trying to invest, don't over diversify. Just buy a few companies, probably 5 to 12 companies. You are in a good place to go. Another thing which you need to understand when investing in the stock market, you need to realize that those companies, and this is something which I came to realize and I took into serious consideration. For example, there are various banks here in Kenya, and there are some companies which have massive buildings, massive structures. And why am I saying that? Those those structures, you as an individual who want to invest in those companies, remember you are contributing in one way or another in paying the rent of those buildings. While there are other companies, other banks, which do also have decent structures, not that massive. That means you are going to get a lot of benefits by you investing in those companies which at least have decent structures, not that massive. That should be the approach which you are going to use when trying to invest in these companies. Also, if there are general meetings or some celebrations which are ongoing with the company, just try to understand how do they handle those functions. Do they overspend the resources in conducting those functions? If they are going to overspend, whether publishing huge magazines or those things, remember those are the profits which could have been granted to investors, which are used to conduct those functions. So you should take into consideration that's how you should be approaching these investment opportunities in any given case scenario. Let's use an example. If it was Safaricom, they have huge printout magazines which they want to supply to every individual. So remember, those are the benefits, those are the profits which you could have gained you as an investor in that company. But these profits have been used to print out those magazines, those news functions. Those are your resources. Maybe it may be branding, whatever, but remember, it's your own resources which you could have gained in terms of dividends or buyback of some shares, but now they are used in a different way. So always be keen in observing those things. You you so one of the things also you should not ever forget, once you have bought these companies which you are aware of what they are doing, Don't buy and forget them. Set a given time frame, maybe after 6 months, 8 months, and check on how they are doing. If you are going to buy these companies and forget about the companies which you have bought their shares, you may end up being frustrated. I need to give you a good example. I bought some shares, not that I forgot them, but I was new into the investing field, and whether you like it or not, you are going to lose money in the stock market. That's the most important thing, is learn from those mistakes which you have already committed. So I bought some shares in East African Cables, and nowadays East African Cables is under receivership. Under receivership, that's what I know. So you can't buy or sell the shares; they are just freezed. So always ensure you check your company, the number of shares which you bought, whether it's in a good condition or it's in a worse condition. If it's in a good condition, you may maybe decide to buy more of those shares. If it's in a bad condition, you may decide to sell. So you always have a time frame which you need to check whether that company which you bought is doing well or it's actually in a bad condition. Now, in any company which you are going to invest, one of the things which you need also to ensure is that the growth of the assets is continually growing. The mindset which you need to develop is, if you are going to buy stocks in the stock market, you are buying a part of a business. So if this business, the assets are not growing, then there's no need of you acquiring something which is going to reduce the assets. That's the you buying stocks, you have bought an asset which is supposed to generate you some revenue. But if you buy an asset which is going to depreciate, then there's no need of you acquiring those shares. So always ensure that a company which you're going to invest in, the assets are growing over a long period of time. On average, it should be 5 to 10 years. Do the averages. Are those assets been increasing or they have been fluctuating so horribly? That's the thing which you always need to consider. Another thing which you need to consider is whether there has been revenue growth. If there has been revenue growth, then it means the company probably is making a lot of sales. The sales have been increasing, and it's from this revenue whereby you are going to generate some net profits. And by that, by increasing some net profits, it may also means the earning per share are also going to increase. So always ensure that there is some growth in revenue, in assets, and also in net earnings. Now, another thing which you should always expect from a company, if you want to invest in any given company, always take into serious consideration that you invest in a company which has been giving out dividends. Why it is so essential? By a company giving out dividends, that's kind of a clear indication that it's in good financial condition. At the same time, these dividends should always be in a constant growth. It should not be giving dividends on an irregular basis. If there is a company which is listed in any given stock exchange market and the dividends it has been giving out sporadically, that's not a company which you should be investing with. Ensure a company which you are going to invest with has a dividend, and this dividend has been growing consistently. On average, maybe it should be around 5 good years. If it has not been giving out the dividends, then probably you should look for a good reason why this company didn't give out a dividend. I believe like KCB didn't give out a dividend, maybe it was in 2022, and probably there was a good reason, because I think it wanted to expand to some East African country. So that's a good explanation of why KCB Bank was not giving out a dividend in that year. So you understand now that this company wanted to make a good investment which would have ensured the company or the investor could gain some growth in the near future. Another thing which you should consider is that when paying a given or when buying a given share, you should not overpay when it comes to the amount or the price which you are going to pay. And one thing which you need to realize that when you are going to buy a given share, the share price is not the factor which is going to dictate the amount which you have what the amount, whether a share is expensive or it's not expensive, but it is the PEE ratio which dictates whether a share is expensive or not expensive. Don't buy some shares which have a PEE ratio of 50. And my own understanding is a PEE ratio generally means if I am going to invest a given amount, how long am I going to receive the exact amount back? That's how I translate a PEE ratio to be. So don't overpay when it comes to you as an individual trying to buy some stocks. Another thing which you need to realize if you are going to invest in the stock market is when you are going to invest in the stock market, it's not a get rich quick scheme. If you are going to invest in the stock market and your time horizon is not around 20, not 20, but 5 to 10 years, then you should consider other avenues which can at least give you a decent amount of interest or dividends. If you are going to invest in the stock market, your time horizon should be at least 5 good years. Otherwise, seek other avenues which you are going to invest in order to receive some dividends and which are going to ensure you don't lose your money as in the stock market, because if you are going to invest in the stock market, it's supposed to be for the long term purposes. Finally, invest funds which you truly believe are surplus. This is so essential. Don't invest amounts which you can't afford to lose in the stock market. If you understand the Great Depressions which happened in 1930, and there was some other depressions or recessions which happened in 2000, 2008, you will realize that the amount which you have invested in the stock market can lose even up to 90% of its value. In 1930, if you invested $100,000 in New York Stock Exchange, there were high chances that you could have lost 90% of those resources and you could have remained with only $10,000. That's how horrible it can be in the stock market. But at the same time, you are assured that you can also gain some massive returns when it comes into the stock market. In 2000s, the stock market in general lost up to 60%. So if you invested 100,000 Kenyan shillings, maybe in any we can translate or we can rate, probably you only remained with 40,000 Kenyan shillings. That's how risky it is to invest in the stock market. Anyway, that comes to the conclusion of this video. If you are interested in this kind of videos, remember to subscribe, like, and also don't forget to share. But one of the essential things which I need to part you with is always invest in the stock market, because that's where you are assured to grow your wealth massively. You can't grow your wealth when it comes to the bonds. It's somehow so, even in bonds you can end up even losing some money just because the rate of inflation may be higher compared to the interest which you are going to earn. So if you want to build your own wealth, just seek what is happening in the stock market. Thanks for watching. I hope to see you or to catch you in the next one.